Okay, so welcome back. We are in our series of the 5 common mistakes that everyone makes in real estate accounting. Number 2 is a very important one that I think we don't always think about, which is recording our revenues and expenses correctly. Now, the argument to that would be
cash, right? Cash is cash. If
right.
it came in, doesn't matter.
Right, which is probably true for how rental properties were up until 5 years ago, right? Like whatever was in the rental bank account, you throw in some numbers in the return, the net is correct because that's what happened in the bank account, and we're good. Well, now that's changed because we have these platforms, right? You have an Airbnb, you have a VRBO, and there's a huge difference between what they're showing as your revenue and what we would show on the return if we did cash basis. And so, yes, are we saying that your return is incorrect if we did a cash basis? No, but what we are saying is you're short-sighting your investment, because basically if we had $20,000 in revenue, maybe you collected 15 because there were fees and there were deposits and you pay back the cleaning fee and all of those things. What we really want to make sure is we have the gross revenue as our top line, cash basis or not, because again, cash basis is just saying that you get it in the right year when you collected it. So I don't agree with that argument, because we want to show your gross revenue. That's what everyone bases the profitability of your investment on. A lot of the, if you're selling short-term rentals, they show gross revenue. So if you show on a return 30 grand and it really should be 50, you're hurting yourself. Now, we're not saying that there isn't still that offsetting expense, but we want to show that offsetting expense, that I collected, my gross revenue was 50, maybe I did spend 15 in fees or whatever that is. That would just be commissions or whatever it is an expense. So again, my net is the same, but now I can run a KPI. I can say, okay, my revenue per month, my revenue per stay, all of those things have to have my gross revenue. If I'm starting with the wrong number, it looks worse on every calculation, every analytic I'm going to do in the property. So very important. On the expense side, same thing, right? We want to make sure we're categorizing it correctly. Is that a utility? Is that, a dues and subscription, like an optional thing? Hey, I pay for Netflix, so I want to show that. It's very important that, a future buyer, a future lender can see that you're diligent in recording these expenses. I mean, so many times I've seen someone uses one personal Amex and we're just guessing, right? Oh, I'll throw that on that property. And that's not how we want to do it, because we want to really understand the profitability of our rental. And if we don't take the time to just make sure the expenses make sense, then we are losing out. The other thing is, we really believe a lot with owners on having a holding company. So if you're running like personal travel or, personal time, all that, which is probably justified for your time in rentals as a whole. Do you really want to be like splitting your travel 5 ways and throwing travel on a rental property? Or instead we could have a holding company and have a fee that the property pays to the holding company. Again, it's not going to change the bottom line. We're not saying you have to amend returns, but it gives someone a much clearer understanding of your profitability of your property and how you operate your rentals. So very important aspect. And if you haven't done it right in the past, we don't need to go back and change it, potentially. But we do want to make sure that we get it right for 24 and beyond. So, thank you.